Officially, again, welcome. Welcome back from our little break this Friday afternoon. I hope everybody's doing well. I hope your day has gone great, hopefully better than we all deserve. And as we're getting into it, I'm still looking at long-term discussions. Friday is Forever Friday. I like to look at this Forever Friday because I still see that rotation is in play, and we're going to take this massive view and we're going to drill it down into specific opportunities. I'm going to take this nice and slow and nice and easy because in this market, the question I would ask, how certain are you? How certain are you in any of the market and the conditions that we're seeing right now that the bull market's going to continue, that the new highs or higher highs are going to play out? What is it that you're looking for? What is it that you're seeing in the market that gives you the confidence? So as we're looking at this, we're looking for the moves and the climbing and pushing up to the next level. We're going to be setting up for some more conservative moves, some pauses, and Igor, another one bites the dust. Yes. What are we seeing? We might see this be the end of the market, the bullish market. And yes, I could put ACDC on next time. Okay, next time I'll give you a little bit more. We'll play Boston and Kansas and ACDC, some of the old rockers. All right. So we're going to walk through and I'm going to show you how we build these things and what we look at and how we find stocks that meet those conditions and what I would be looking at in this market. So as we're looking at this, I do want to throw back on the S&P futures. This is something I talked about before, and we're going to get into it after we talk about rotation. And one of the key things I like to look for is the trend associated with at least two, if not three different time frames and signals. And when we see those correlate and cause a barrier, and we see the tops being put in, to me, this view through here is not just that we've reached a pausing moment. We've made a gap up that didn't make a new high, a gap up close down that did make a new high. This is uncertainty. As we sit here at the top level, what do I look for? Well, we have different timing. We take this close, and I like to use close prices, and I like to cut through the noise. So if we have closes here in the gap up, close down, that close, that close. So look at all the closes I'm hitting. One close, two close, three close, four close, and then these shadows are just touching it. This to me is failing to break out to the next level. I'm not going to go off just two touches. Remember, any 2 points make a line. It's not good enough. I need to have 3, 4, 5 different points on a line to really trust that it's a good indication off those levels. I am the close master. Yes. Are you the gatekeeper? I am the close master. For those of you maybe that aren't seeing what I'm doing here, I'm going to change the style. I'm going to go here and I'm going to change it from candle to line. The line shows you the close price, and I'm trying to hit as many of those as I can. And if we look at the closes, you see there's 1, 2, there's one right here that was harder to see, 3. And we have 3 touches through there, 3 closes through there. And so these shadows are just failing up at those top levels. And so to me, it's overextended. To me, it's struggling. To me, it's got to do a lot more to be able to get through this high and break the channel, break the trend, and get through 65.1275 this month. So that's my first warning, is that we've probably become overextended in this chart, at least on the broad market. So then the question is, what's next? What are we looking for? I want to see 3 different time frames, but I want to see how rotation is fitting into this. And again, we're going to take this really big view, sector rotation, drill it down, and find the best sectors in the rotation in conjunction with long-term trends, long-term cycles, and then we're going to find the right stock. So as we look at this rotation, I'm going to throw back to one of the things that I like to look at, and that is the business cycle. If we're looking at a healthy economy, and I've been hammering on stagflation, even Garrett's talking about stagflation now and looking for hints and words along that with Jackson Hole's summit coming up. But if we're looking at this, do you feel the sectors that are doing the best are over here in consumer staples, utilities, and financials? Or are they here in technology, service, capital goods? And we're going to cut off the rotation. It should be a circle. I still need to make a new circle one that makes more sense. But as we're looking at this, consumer cyclicals to transports, the base transports over there, this move over here is kind of the end of the late contraction, the end of the recession, the beginning of the growth. By the time GDP rises, by the time GDP turns a corner, we're already late. We had one negative quarter, then we had a positive quarter. If we see GDP hit 2 negative quarters in a row, we're going to be late to the game. So which side do you think we're on? And I don't want your opinion of what you think is happening at Walmart right now. I just want you to tell me who price-wise, purely price-wise, have you seen do better in this market? Would you say that the technology has outpaced everything else, or would you say service and capital goods are up at all? Would you say consumer staples and utility is stable? What about financials? And if we're expecting a rate cut, does that change your view? Well, in the end, we really just come back down and say, show me who's winning and who's losing. Whether we're looking at a 6-month rotation, or I prefer the 3-month quarter, but we're going to do both. We're going to look at 6 months and we're going to look at 3 months here on the live charts. Let's take a look. Let's see who is doing better, who's doing worse in this time frame. So here's my 3-month time period, and there's 2 things that I look for. Yes, top performer and bottom performer, but I also look for lines crossing 3 or more, 3 sectors or more. So this green line right here was the best performer. And what happened? It was the best performer and it crossed 3. Best performer and it crossed 1, 2, 3 again. And that was all the way back in July. So the fact that it's here in the middle after being the best and whipping both directions, we've gone top to bottom to top to middle, second from the top anyway, to middle. And that is going to be your oops, whoa, that's supposed to be energy. That's not supposed to be Southern. What in the heck? Well, I grabbed hang on, that's my wrong chart. I'm supposed to be using the one that has energy. Energy. I apologize. This is my deep currents rotation chart. But that's still important for what it's not what I was going to show you, but it's still important because that's a representation of copper and growth, SCCO. And what we're seeing here is that we've gone strongest, weakest, and we're seeing that fail. So basic materials are failing in that move. What I wanted to show, what I wanted to spend some time on, is the actual sectors so we can go back to that business cycle. I will come back to this in a minute, but that was showing us that copper is not doing well, and it's the reason why I'm still leaning to stagflation. Even though gold is not climbing as a hedge, I'm still leaning to stagflation in that market. Now, the very top one here is technology. No surprise there. But we're looking for the ones that have crossed multiple lines. And if I put my cursor on this, makes it a little bit easier to see who's crossed multiple lines. This was second. It dropped through 3 charts, came back up, and is now second again. Communication was strong, weakened a lot, and it was recovered. So the top 2, technology and communication, is holding up the S&P 500. When 2 sectors hold up the entire market, and the rest are way down here, this tells you that we're overbalanced in those top 2 sectors. And if we're looking for those that have crossed up and down, we're going to be looking at this. Healthcare has gone from the second weakest and crossed 1, 2, 3, and almost 4. So healthcare is coming back and as an opportunity. Basic materials is in the bottom portion and is starting to fade. And I already showed you copper there. And our very weakest down here that turned from the weakest to second, crossed 3 lines, and that's energy. Energy crossed down through 3 lines. There's that September 28th I was trying to point to, with energy weakening, crossing down through multiple lines. So energy prices, basic materials, they're the ones that had some strength and have given back that strength, whether we're talking about copper, whether we're talking about oil, basic metals. Miners are doing fine because of gold and silver holding near their highs, but the basic materials have not done well. Our very weakest right now is real estate, which, if we really were betting on a healthy market with lower rates, real estate should be up a lot. It's not. It's the weakest of the weak. It is the very bottom, and energy's down there with it right next to it. So in the middle, really, healthcare has come up, and right through here, consumer discretionary is fighting because it's being weighted by Tesla and some of the tech stocks, but industrials are fading, and everything else now besides those top 2 is industrials, utilities, healthcare. and we're seeing a return to those defensive plays. That's over the last 3 months. If we look over here, get rid of that once again. If we get back to the broad market and focus on what we're seeing in there, we can go right into the individual sectors, and we're going to determine whether they're opportunistic to buy or whether we should be avoiding specific sectors. As we looked at that, we saw healthcare. Healthcare has recovered off of its lows. Today is now the time to buy. Keep clicking on that, and I do not mean to. I apologize. It is now the time to buy, purely based off the chart. Am I cutting out? Hang on, let me close a couple things. I might have, because I opened up a couple other platforms. Let me fix that for you. See if that improves. We'll clear out the noise, clear out the platforms. And see if, tell me if this is, let me know if this is improved as I close out a number of these things that we have open. Let me know as I talk. And so Peter's saying, no, wait for it to break out. Carlos says, maybe. Top of the range, though, as far as that chart is concerned. KKTC is a bear, wants to sell into that. Nothing wrong with that. It's not necessarily the time to buy, but the recovery is strong. Still cutting out? Sounds fine now? All right. I did close a number of things, so hopefully that is enough. Had too many things open, apparently. I can close a couple of other things here. Sound and video is good? Better? All right, perfect. I had 4 different trading platforms open. And so when you have charts and 4 different trading platforms and PowerPoint open, I just think it had too much of a drain. Yeah, so Maori and Gergeau and Carlos, yeah, I'd like to see it break through here for timing. But the thing is, if we're watching for these things, we're watching for the expansion and recovery. When we see things get to extremes, this bounce here off of the annual lows with a higher high, higher low, higher close off of the previous channel, the entry could have been there. If we got up here, I would like to see it break out, and then I'd probably sell a put spread. We'll get into the strategy in a minute. But healthcare's had a fantastic recovery off the lows, but it's probably a little bit late to buy into it now. If we go through those others, what are the other ones we were looking at? I said financials. Are financials doing well over the quarter? Not just right now. Are they doing well? I think they're doing great. Financials are holding up here. Now, today is interesting. Do you want to buy into financials at a lower high with a widening candle? We expect financials to do well towards the end of that business cycle. And that business cycle is not a good business cycle. When we're looking at those moves, we're saying, wait, you're saying that financials have a tendency to do well in the late stages or the beginning, late stages of contraction, early contraction, beginning of the late part of contraction, and early recession. That's what we're saying with financials. That's when they have a history of doing well. So as we're rotating back here, we're talking about here, is financials doing well? And to me, we might be. Healthcare doesn't have, healthcare, yes, is defensive, but it doesn't have the same cyclical behavior. You'll see I don't even put it in here necessarily. It's going to fit with defensive sectors in general, but not as a standalone. Healthcare can have varying cyclical behavior, but overall, I'd put it up here early on. So they've already recovered. Could we be here? Are financials holding up to the top because they're doing well? Let's take a look at utilities and consumer staples to see, are we here or are we at the end of that time frame? Consumer staples and utilities in this rotation. And we're looking specifically at Is it doing well over the quarter? And is now the time to buy? So if we take a look at consumer staples, my question for you, has it done well this quarter? Yeah, so again, Mallory, I'd probably wait until it healthcare clears that high before I step in. But after it clears the high, yeah, I'd have no problem selling puts. And it depends on the volatility. We'll determine the proper, if you want to call it that, the proper strategy after it's there. Mallory likes the RSI. Now, it's stable. Not breaking free, but it's stable. Over the last quarter, we got to go back from 8 to 5. We're saying, yeah, it's up. It's stable. It's up. It's in the middle. I would like to see it clear this level. This is one of the levels I've been watching. I'd like to see consumer staples in general break free, but it doesn't mean that I can't find a consumer staples trade. Overall, so far, I think we're showing signs that that's where we're at in the cycle. In the economic cycle, we're more likely in the area where consumer staples, utilities, healthcare, and financials are holding up near their highs, their quarterly highs, and holding up in that area. Now, utilities, they're right here at previous resistance and support. Who watched yesterday's video? Did you see yesterday's video on my Thursday afternoon video? Is this time to be a buyer? And even if it's not time to be a buyer, are you feeling like you should be bearish? Would you look at utilities and say, this is a place where I want to buy in, sell short, hold? What do you think? Don watched it. Don watched all of it. Ooh, interesting. Why? Why would you say this is sell short? It was real and it was spectacular. Awesome. So as we're looking at this, I'm gonna go against you. I wouldn't sell here. I don't think this is a sign of weakness. I think you've had a long-term uptrend, and Dow theory explanation of trend says higher highs, higher lows, higher highs, higher lows until you have a full set of lower highs, lower lows. So the trend has been bullish since it cleared the high, made higher highs, higher lows. Even when it's consolidating, that's not a downtrend. It's consolidation. And it's consolidation of an uptrend, not a downtrend until you create a full set of lower highs, lower lows. So when you broke back into the higher highs, higher lows, this is higher lows. This is a bounce off of support. This is a setup for me that I could be a buyer. But if I don't want to be a buyer, what can I do? Hold the thought. We're going to come back to utilities after we hit two more. Like I said, I want to show you consumer discretionary now and rotate around the other side to take a look. Exactly. We can sell put spreads if they're priced right. We'll do that here in a minute. And we're right at a channel support. I really like this channel support level too. And I'm looking for it to go all the way back up to 90. And we'll get back to that as broad utilities ETF, but then we're going to drill down into more specific. As we look at this, take a look at consumer discretionary. And one of the things about consumer discretionary is this rally was odd. And part of the reason, yeah, man, I've got a lot of lines. Who looks at this many lines? Get rid of that. Get out of there. Be gone. I'll still leave that one down there. But we sold off. Notice that we created a higher highs, higher lows, higher highs, higher lows, higher highs, higher lows if you count this one. And we broke out. We created a widening pattern. We went widening pattern into widening pattern. So this one's a little trickier because we already reversed and broke out 1, 2, 3, 4 different support levels as far as closes go. And then we returned right back up. Who is in here? What is driving this? If you look at XLY, and we've got the time today, so we're going to take the time to walk through this stuff and make sure we understand what we're looking at. If we look at consumer discretionary, and we'll look at it from the heat map, we can look at percentage weighting here in a second as well. Who's here? What's driving this move to the new high? Is it Amazon? Is it Tesla? Starbucks? Home Depot? if we look at this from the fundamentals tab, what you're going to do is you're going to go to analyze, and we're going to click on that and go to fundamentals, analyze, fundamentals, and scroll down from XLY. Oops, not on gold. Stop it. XLY. And when we look at XLY, look at the weighting that goes into consumer discretionary. Amazon is 23%. Do you think discretionary income wise, that consumers' discretionary income, that maybe 23% of it would go to Amazon? If you looked at the cardboard boxes and bags, and the fact that my dog knows our FedEx guy, he loves our FedEx guy. I can say his name. I say, oh, I hear Rob, and my dog goes nuts because Amazon shows up at my door every day, pretty much. So I would say, yeah, 23% of my discretionary income apparently goes to Amazon. No, I'm just saying that's not that big of a stretch to assume that that's the case, whether we're talking about that here on Amazon or not. But if I look at Tesla, do you think anyone spends 16% of their disposable income on Tesla besides Don and his desire for that Cybertruck, that cyber dumpster? Does anyone spend 16% of their discretionary income on Tesla? So there is the problem. I think we could stretch and say, yeah, maybe a quarter of our money goes to Amazon, but not Tesla. Do I think that 6% might go to Home Depot? Yeah, if I'm doing repairs. What about 4% to McDonald's? Maybe that's a lot of McDonald's, but even still, or maybe you don't have a lot of discretionary income. I think these are all reasonable except for Tesla. So Tesla makes it so this is not a good representation of what historically was consumer discretionary spending. I think Tesla throws off this indicator. And if we go back to XLY, if it's an indicator for sector rotation, what has Tesla done during the same time period? What would we expect to see in Tesla in this move? Would you expect to see a lower low and a higher high, an expansion? Yes, we get Amazon packages through FedEx, Postal Service, and UPS, as well as Amazon trucks themselves. So they come all sorts of ways. But my point is that Tesla is overweighted in that. And so as a sector rotation indicator, I'm not going to trust XLY nearly as much. I would rather use Amazon in general, and look here, is it new highs? Is it expansion? It's going to have to retest. To me, this is a reversal and a retest of the previous high. And I used to use Nike. Nike was almost perfect as a representation of XLY minus Tesla. And again, we're not making new highs. It's all being lifted by Tesla right now. So I want to dismiss XLY as a possibility because I don't see the strength in there. XLK, we've already shown that that could be the case, but XLB is the last one we're going to go through before we go back and start looking for trades. We're going to look for opportunities and how we trade it and when we trade it. And Don is in defense mode now. He's going to defend his justification of having a Model S and a Model X, and the grill needs a Model Y, and the truck is going to happen if it's going to fit in his garage. Plus, he's going to fly up here to pick it up so that we can go out and I can take a ride in his Cybertruck. All right, XLB, equal highs, breakout, double top, breakdown, hits the full target. Right now, it's sitting at the zero. This is a failure to break higher and a setup to create a lower high after creating a double top, and a double top is a reversal pattern. So I don't see the XLB or consumer staples is anything strong. So we're just digging through the analysis of what does it mean in conjunction with the long-term business cycle. Now, after showing you those charts, are we on this side financials, utilities, and staples, or are we on this side, technology, capital goods, and services? I've heard Don and Don saying he needs to know his Cybertruck's good in the snow. I've heard it's not. I've heard it's actually very bad in the snow, and there's videos around here because we have a lot of snow out here that it doesn't work, that it fails miserably. But you know what the biggest difference for a car in the snow? What's the number one thing that's going to help you with cars in the snow? Tires. Get good tires. Yep, I agree with you, Master Barge Jay. Everybody thinks it's all-wheel drive. All-wheel drive might get you moving, but it does not get you stopping. And what will happen is if you have good tires, you're not going to have trouble starting, and you will absolutely be able to stop. Well, much better anyway. So spend the money on the tires. Get the good tires. And wait, waiter, don't drive. I agree with that too. Front wheel drive and good tires works a lot better than average tires and all-wheel drive. So just get good tires. All right. So drinking helps Don in the cold. Cheers. Chains. Yeah, you can do chains, but just winter rated, snow rated tires. There we go. And weight for sure. All right. So everybody's saying this side. So that tells us stuff, doesn't it? Doesn't it tell us that we should be looking at this side of the chart and wondering what's going to happen next? Commodity prices. Did copper fall? Did gold fall? Well, gold pulled back a little bit. Are copper prices, basic materials struggling? Yes. Property values were falling until we got an announcement that we're going to that made people start betting on rates. What about bond prices rising? Are we seeing opportunity here? If the stock prices start to fall, if we see real estate prices fall, and real estate's not doing well, and we see bond prices start to rise, this is where we're at, and this is where we should be paying attention to. This is where we get into the defensive mode. This is when you see markets and big institutions and retirement funds start looking for what I've called yesterday or reminded you of as risk-free premium. So as we're looking at this, we're going to go through the rotation. I want to look at the yearly charts on the yearly and the monthly monkey bars, looking for stuff that shows me we're overbought. And we can look at weekly and daily as well for precision, but I want to look at the yearly and monthly to find the real opportunities. I've already shown you that over the month, the S&P 500 is overextended and struggling to move higher. And then we can confirm with golden cross and death cross for super long-term trends. We can do other things, volume indicators. But we're going to come back to this. And we're going to look for specific stocks that meet these conditions. And I'm going to walk you through step by step what I showed yesterday on how to build your own searches. And you can change some of these things out if you want, but then we're going to look for the searches and the filters to give us the timing on the individual chart. So find the right stocks, time the right stocks, pick the right strategy. That's what we're going to do for the next hour. We're just going to walk through and pick and find and set up everything that we're going to do for these long-term pictures and long-term view. And then we'll decide what's good from there. So to begin with, I'm going to go into the scan, knowing that we're in this area that we might want to start looking for more defensive. And I'm going to clear everything out, okay? And we're going to simply start with all symbols. And if I go scan, all symbols, and 88,574. Now that in the article that we wrote up with the video yesterday, we talked about 74,000. But theoretically, there's 88,574 stocks. 88,000. How do you choose among 88,000? Well, first off, the fastest, quickest, down and dirtiest way to get liquidity, I would say take your all symbols and say, I'm kind of interested in stuff that gives weekly options. That's going to cut out a lot. It's going to reduce a lot. Now watch this number, 88,000. And I'll share the scan after we build it, but I'm going to walk you through the logic. This does mean that we're going to miss some stocks that could be really good stocks that have monthly options. If you see it's cutting out too many, I will show you how to fix that while still having liquidity. But let's start with this. We're going to scan in weekly and watch our 88,574 drop to 638. Now, that is a fast drop. Absolutely a super drop. 88,000 all the way down to 638. Now I jumped the gun. I was going to show you the 60% first, but going from 88,000 to 638 just by looking at weekly options. Am I buffering? Let's just double check before I continue on. Am I buffering and pausing? Hmm. Let's see what else I can get rid of here. Delete Dawn. Just kidding. I won't delete Dawn. Just closing a couple other windows. Making sure that we have the volume and the freezing in and out. Am I still freezing? Let me know. Anyway, while I continue to talk, as we get into this a little bit further, all the talk about snow is freezing the screen. We should never talk about snow. Snow is terrible. I do not like the snow. So we dropped it down from 88,000 down to 600, less than 1% in a matter of one search by just getting to the weeklies. From here, I'm going to add a filter. I'm going to add a stock filter. I'm going to add that the ask price is somewhere above 20 bucks. Okay. Now, if I just look for stocks over $20, the options are going to work for us. And so if we know that we have options that we're going to trade and we have $20 stocks, it should be okay here. I'm going to hit 20 and now we're down to 453. What clock are you seeing? I don't have a clock. Are you talking about the clock up here at the top? 12:32:14. All right. So we've dropped from 88,000 now to 400. So we're less than 0.5%. Less than 0.5% in this scenario. Are you talking about the clock up? Yeah, and I even hear my voice. I just unfroze it there so I could see. All right. So we're now at 0.5%. 99.5% of the stocks don't qualify anymore. We're not here to pick everything. We're not here to chase the high flyers. We're not here to assume that we're going to get a penny stock that's going to go from 1 penny to $1 in order to make 100% in a week and a month. I've just eliminated 99.5% of the stocks. Now we could just stay here and work with 453, but oh, wait, there's more. Let's add another filter on, and I'm going to add stocks again. And this time we're going to go with volume. Okay, we're going to use a volume, and we're going to say that we want to know that there's 1 million shares traded. And generally, if it's earlier in the day, I'll go as low as 500,000. But where we're towards the end of the day, I want 1 million shares a day. Okay, and that's going to give us 1, 2, 3, 4, 5, 6. That's going to give us less stocks again. There's only 532 that match here, and we're going to add some other filters. What are the other filters we want? I want to know that they're going to pay me a dividend because we are looking for that return. So we're going to go to fundamentals and we're going to do dividend yield. That our current dividend yield is at least half of what we'd get out of investing in bonds. And so we can start with 2.05. We're at 4.15 on short-term bonds. So we're going to go to 2.05%. That's our current dividend yield based off the price of the underlying stocks. Now, just saying dividend stocks that have weekly options that have good volume, we've now gone from 88,000 down to 98. Is 98 workable? What do you think? You want to run with 98? We can't get through 98 stocks in an hour. I mean, we could try. but 98 is workable. I would think you could sit here and go, yeah, I could look at 98. I really could. And start you, and we can dig our way through here. By the way, yesterday, in the middle of the class yesterday, I said, I like UNH. Are you comfortable with buying it? Freddie says too many. We're going to filter down again. But yesterday, I said, I like UNH. Are you comfortable with buying it? I didn't know it was going to jump 13% and $35, but it certainly met my conditions to step into it. If I stepped into it to collect that 4% dividend yield, I would have already gained 13% on it here. So Johnny brings up the next one that I look at. Now, there's two others I'm going to look at, and I'll just tell you up front. That is, I want their earnings to be positive, because if their earnings are not positive, they're not going to keep paying the dividend. Ask price. This is just really price. The last ask price. I could have changed it to last. I just want to know that the stock price is over 20, because even if stocks have options, if they're trading at $15 or $10, the options aren't doing anything. They're not really helpful. So I really want to know that my stocks that I'm trading are over $20 a share. Yeah. So yesterday we set it up. I told you about it. We showed you this. I was very clear. Said, this is where it's at. Are you comfortable with it? It has been oversold. It's been beaten down, but it's a good stock with a good dividend, and there's a lot of upside potential. I didn't know we're going to hit the whole year's upside potential I was pricing in a single day, but it certainly set up for an opportunity. Let's add those two other filters, and that is free cash flow and earnings. We need positive earnings. So we add filter again. And we're going to add filters. We're going to go to fundamentals. We're going to go here, and we're going to say, I want to know that my earnings per share, and we can do earnings per share trailing 12 months. So for the last year, that's been positive. We could just do earnings per share most recently, but let's just use trailing 12 months. That's what TTM stands for. TTM. So we're going to put in 0. If you are not making money over the last year and earning something over the last year, you're not going to keep paying your dividends. And that's the same thing with free cash flow. If you don't have cash flow, we add one more filter, earnings per share 0 or higher. So you got to be making money. And we're going to do free cash flow. Now, I also like the fixed charge coverage, but we're just going to focus on free cash flow today. Okay, and we're going to get rid of that. If you don't have cash flow, not only are you not making money, you don't have cash flow going through the company and available to you, then these are the things that would cause you to stop paying your dividend or cut your dividend. Because even if you're making money, if you don't have cash flow, that's the lifeblood of the company. So let's go ahead and scan one more time with all these filters added in. And they're not that money. This is not that restrictive, but it's simply going from $88,000 stock to weeklies. We went whoop, down about 700. Then we said, let's add prices that are over $20. We dropped again, volume dropped again, dividend yield dropped again. And so as we're building this out, we've gone from 88,000 stocks down to 98. We've added 2 more filters in here. And of all these 88,000, how many of the 453, 532, 157, 414, and 379 are going to overlap where they're all in agreement? Because there's stocks that have over 0 but aren't necessarily a stock above $20. There are stocks that have free cash flow but might not have a dividend. So the fact that there's 379 is, where are the Venn diagrams lining up? And for some reason we're not getting our results. Come on. Collect garbage. Scan. Scan. Give it 1 second. We'll see if we get this to pull up. We should have about 30. There we go. Oh, 74. We have more than we did yesterday. Interesting. Ooh. Okay, now we're to 74. It was just, apparently that takes a lot of scanning power, Freddie, so we should be back. It was, the wheel was spinning. We are currently on time. We have everything playing and broadcasting as it should. So what do we have? United Healthcare, Cisco. And by the way, I have it currently sorted by volume. So the highest volume is at the top. United Healthcare, Cisco, Pfizer, AT&T, Bank of America, XOM, ExxonMobil, NVO. Notice something that's going on here. How many of these stocks are healthcare, financials, healthcare, energy is an interesting one, consumer staples, communications are in there, staples, and again, a lot of energy. Energy stocks are going to be dividend payers anyway. And we know that energy is kind of jumped, pulled back, and stabilized in the middle. If they're in the middle, it's okay to have a dividend stock in there. I don't need any of these to go up. I need them not to go down. The dividend we're going to get and the payments we're going to get, there's 74 here, and we're going to try to trade this to see which ones are our right opportunity. Now, United Healthcare moved too quick. I'm not going to chase this one, but I will show you how we can analyze it like I did yesterday and determine whether or not it's time to buy or not. So what we're going to do is we're going to go up to the top. We're going to click on the charts, and we're going to put in United Healthcare. We're going to start with this one. Then we'll do Pfizer, and we'll walk through step by step. We've picked sector rotation we want to look at. We've picked stocks that meet our qualifications to have dividends, positive earnings, positive cash flow, and have weekly options. We don't need to do a lot of other things. There might be stocks we're missing out on, but we don't need to do a lot of other things at this point. We've reduced from 88,000 down to 70.1%. 0.1%. So United Healthcare, even with this bounce, gapped up, closed higher. What can we do with it? And I'm going to get to this money flow here in a minute too. That's why I have it up today. What can we do? Let's go to the trade tab. And I'm going to walk you through the steps one more time on the basics, and then we'll analyze stock after stock after stock in conjunction with what we're seeing here. Number one, if I'm interested in United Healthcare and it's a dividend stock, we went from 4% down to 2.8 because the stock price jumped $34. It is what it is. So at this moment, are the options with today's super bullish move, are the options expensive or cheap? Did we add volatility because it's such a violent move up? Or did we lose volatility because the stock price went up, which is usually less of a hedge? If I scroll all the way down and I look at the implied volatility with today's move, my general rule, I'm going to walk you through here, is 0 to 35%. Generally, I want to be a buyer of options. 35 to 50, it's a coin flip. 50 and higher, absolutely seller. Now, the fact that we're at 34% is kind of on the edge. I could go either way, but this would be one that I'd say, this is where I'm looking to buy calls or buy the stock if I want that dividend. James, the only reason why UNH is at the very top of the list is because it has the highest amount of volume. That's the sorting. I didn't do it based off dividends. I just have it sorted based off volume. Since we already have volume, we can actually sort the list to other things. Yeah, if I want this dividend, I've got to be a buyer of the stock or a seller of the put, so I end up owning the stock so I can be a buyer of the stock. So this is on the edge. I could go either way with that, 34%, 35%. So it's getting up to the point where 34 percentile is at the edge of where I might want to be a seller. And I always run the numbers first based off of 30 days or close as I can to a month to say, okay, what am I getting paid for a month? Normally, if I'm trying to get the dividend, I'm going to look at selling at the money, meaning closest to the current price. If I want to get paid and get into the stock at a discount because I want to own the dividend or own the stock to get the dividend, I want to sell as close as I can to that number, which is 306. That means 305. That would be the number. So even with this huge move up today, which is 13% climb, 12.8% climb, I could still sell the 305 and they'll pay me 3.98. It was 4% just a second ago. Easy enough? Sure. But because it's kind of got away from me, and maybe I don't want to own UNH, but I do know that if I'm thinking this, if dividend stocks are going to come into vogue, if we're going to be interested in placing trades in options specifically to collect dividends, I don't have to be the one that owns it. All I have to know is that it's going to increase the demand for those dividend stocks. And if that's the case, I can sell premium and just collect that premium. I could buy calls and collect the directional move, or I could buy the stock and collect both. I think we've already jumped 13%. We could certainly start this 4%. And if I ever see something like this that I don't necessarily want to own, I target 2.5%. This is telling me that I could be willing to buy the 295 stock at 295 and collect $7.50 in a put. If I collect $7.50 in a put at 295 minus 750, 725, whatever it ends up being, then I have a cost basis of 287.50. Did I do that right? I think I did. 287.50. 287.50 from the current price gives me what I call the safety net. I'll share the scan with you, and then we'll do the same thing with Pfizer, and we'll walk through 3 or 4 more here. Okay. If I'm looking at this, I think I misunderstood. I thought I had an hour and a half. Do I only have a half hour? Maybe let me know. All right. Or do I only have an hour? Hour? No, that's right. Hour and a half. Yeah, 1 hour. Got it. I thought I had an hour and a half. I only have an hour. All right. I was looking at the schedule again. I want to see how much time I have. So I only have 14 minutes. So we'll get through as many of these as we can. The distance between 306 and 287.50. The stock price would have to fall 306.50 minus 287.50, which is $19. Divide that by the current price of 306.50. It would have to fall 6.2%. If ever I can get double or more of that 2.5%, I'm interested. But I look at that and say, this has a 6.2% safety net or margin of safety to collect a 3% yield plus any bullish appreciation of the stock. Making sense? Don't make me share back your schedule with you, Don. I know how much time you gave me. All right, let me share the scan with everybody first, and then we'll go on to Pfizer and AT&T. But actually, let's share the scan, and then I'm going to filter it differently. Okay, or I'm going to sort it by yield. Let's go with the yield next. We already know it has all of these have enough volume, so I'm going to go to share the scan. Share scan query. Dividend scan query for today. And I'll share that in the chat. The schedule had me for an hour and a half. And in my head, I saw that, but what it was is I was playing music for a half. And so in my head, I thought I was talking for an hour and a half. Nope, I'm not. So I will be done here in 12 minutes and when I pass the ball to Corey. But let's keep going. Let's keep going. Yeah, I see the schedule. I was thinking that I had to pass the ball at 1. So I'll make sure I do it. 3 o'clock Eastern. Now let's change this and we're going to go to dividend yield. I'm going to sort based off dividend yield. The only reason why UNH was at the top is because it was the highest volume. So as we're looking at this, Dow Chemical or Dow Inc. and Pfizer. So let's do Dow, Pfizer, and Mo Altria. Okay, Dow. First off, tell me, how do you like the chart? How do you like them beans? Would you be interested? I wasn't obviously didn't take some time to look at this one. Would you be interested in Dow at this moment? Take off, hoser. Lawyers are for sucks, eh? As we look at this, steamroller. I'll look at Mo. I'll get to him. We got time. Dow Chemical is kind of a no for me as well. We're right here at fair price, and the volume is below the 0 and below its own average. So this one's holding down, weighting down Dow. As far as Dow is concerned, the Dividend is 5.95%. If I scroll down, the current IV ranking is 50%. And so I'd go to that 1 month and say, what are they willing to pay me at the money? At the money, 23.51. We could go 23. I'll go out of the money. But 4.81%. They're willing to pay me 4.81%, which means that I have a margin of safety that's going to bring me down from 23 down 105. My area that I get assigned is $23 minus $1.05. That is $21.95. $21.95 from the current price. We'll get through all of them. $21.95 is $1.55, well, $1.56, and $1.56 lower than the current price is 6.6% margin of safety. So 6% margin of safety is not double what I'm getting paid. That's a little bit of a concern to me, but I don't mind it. The idea of stepping into this, if I'm comfortable with the idea that it's not going to go through 21.90. If it holds here, great. If it pulls back, great. And remember, what we're doing is getting the dividend to get into the trade, the dividend payment, and where we're going to be looking at holding it, or the short put to get into the trade, dividend of the payment, and any directional move. But that 5.96% dividend, their price to earnings ratio is negative, so they apparently my scan didn't filter them out, which it should have done because their PE is negative. They have negative earnings somewhere in there. So let's go take a look at Mo and Pfizer. Starting out with Pfizer. While I'm on this page, I'll just scroll down because I've got 9 minutes. Look at the current IV ranking. Pfizer is cheap as far as its options are concerned based off the last year. This could tell me just buy the stock. The $25 stock, get a 6.82% dividend. Let's look at the chart and determine whether it's worth looking at and say, do you like this stock? Do you like my decorations? I like this one. I would like it to have a better close outside the monkey bar. The gap up and close down is a little bit of a concern, but I like this for 3 different reasons. One is at 6.8%. That's awesome. 2, it's a monkey bar breakout as of now. And 3, our average volume, our Chaikin money flow, my modified money flow index, which tracks the averages versus the zeros and the deviations, this went positive. This is saying we are buying up Pfizer. So Pfizer is willing to pay me a 6.8% and broke out of my monkey bars. Even though it's not a strong breakout, I don't need it to go up. I just need it not to go down, and I make money. So if I can get 6.8% for the year, and if I do get the directional move and even just get up into this monthly monkey bar at 27, I'm going to gain another 10 to 12% plus the 6% dividend. And the options are low, so I really don't want to be a buyer or a seller of puts because they're only going to pay me 1.6%. Proof that does not price in enough to sell puts. I just need to be the stock buyer or buy a call for the directional move. The dividend is 7.25. It's quarterly, so the next one is probably 10.25. So that tells me I could just buy the calls because they're super cheap, either out of the money where my target is, or in the money at a delta of 7, or do an in-out spread like Don likes, or an in-out spread like I like, which is different, and play for that directional move September, and then try to get into the stock before that ex-dividend date. So I could capture some of that move. If we go up to 27 and I were to buy in there, if I were to buy in there on a spread, in-out type spread, I could buy the 24 and sell the 26. It cost me $1.10 to make a $2 move with a high probability. You know it. I'm always different. Let's take a look at Mo. Down here, fairly inexpensive. Not high, not low, but fairly inexpensive at 23. So I probably am just a stock buyer to get that 6.17%. Look at the chart. Holy cow. Mo to the moon. Mo pulled back and gave me a buy signal today. I look at this as a buy signal for Mo that we could go, Altria could hit 70. So if I buy in at 66 and go to 70, we're looking at a $4 move. If I look at the dividend, that's just for the month. If I look at the dividend, they're going to pay me $1 dividend here mid-September. The options are cheap, so I don't really want to be a seller, and it's only 1.6% proof that I don't want to be a seller there. So it says buy the stock, so I can collect the dividend and collect the $2 or $3 move that it could go up to, or $4 move up to 70. Probably not going to buy the calls because the calls, even though the calls are cheap, if I want to get that dividend and get paid the dollar. So if it goes up $4 in this month alone, and I collect the dividend in this next month, 1 month from today, roughly, then I've now collected $5 on a $66 stock. Even if it doesn't go up to that level, I'm still looking at potentially getting the dollar, which is part of a 6% yield. 6% yield that I'm getting paid in 1 month from now. Well, what is the equivalent of a 6% annualized yield? If I collect all 5 of those dollars divided by the 66, that is 7.5% for a month. 7.5% per month on a stock that is just going to go up and test its next target and pay me $1 dividend and give me the choice to then sell calls and reduce my cost basis further. How do I know I'm wrong? If we close below 64.82. Alrighty. So if we close below 64.82, I'd say close below, get out. And otherwise, I'm waiting for to give me that 7.5%. 7.5% on a consumer staples that's in the rotation of the financials, or not the financials, the economic rotation. Economic rotation says bet on consumer staples. Altria is obviously one of those. Altria has had a ripping year. You can see that sideways and then explosive move to the top side, starting with earnings. And I'm looking up for 70. I could get 7.57% in a month off of a dividend stock that has already got an uptrend, that is going to be fairly stable. And even if it goes sideways, I still get paid my $1 against a $66 stock just for being willing to sit there and collect a dividend. And that's all I need. Now, we could have gone through all of these, but let me go ahead. I can share this chart with you. You want the Mo chart or you want the Kroger? Here, let me share Mo with you. I'll share Mo, but I don't want no Mo. Mo charts, Motown. Do you see that pullback? Sure, I see lots of pullbacks. I see dead people. Gap down. We talked about this a couple days ago, that it came down and tested that area right through here. Kroger, as long as I'm getting the dividend, it can still say net flat for the entire year and we make the money. It's only 2% though. Probably not what I would chase. It's right on the edge for what I'd chase anyway. So if it's 2% at the lows, that means it was 1 point something at the highs. All right, so you now have my Mo chart. You now have my scan. We've now talked about the idea of going from 88,000 stocks, bringing it all the way down to less than 80. So we're talking about 0.1% of all the stocks available down to less than 80. That scan's kicking out these stocks that are going to give us dividends on stocks that are still making money, that have free cash flow, that the dividends about half of what you'd get on a bond, and yet has all the upside potential. It's a low cost trade. It's a low risk trade. It gives you a margin of safety. If it sits flat, we're fine. Trump and Putin just landed in Alaska. Let the games begin. And with that, we're going to let the games begin further. So Corey's coming in the house and he'll be taking over here in about 2 minutes. And he'll take you through the next thing. I would tell you to walk through, just pick some of these stocks and say, do I like the chart? I don't need to have it go up. I just have it. Do I feel comfortable that it's not going to go much lower? It's going to hold where it's at or go higher. If that's the case, then I'm interested. Then I just have to decide what's the next step. What's the strategy that I want to use in there? Do I want to be a buyer, a seller? Do I want to short the put to get in the stock or just buy the stock outright? I'm going to go into those and find the next trade, the next opportunity, and control my risk and sit there and collect the money. Doesn't have to go up. And if I get a high premium on the short put because that IV ranking is high, we can get as you've already seen, 4.5%, 5% for 1 month worth of time for being willing to own it. And then if we end up owning it, we have a 4.5% discount compared to current price, and we now start collecting those dividends. So pay attention to where those dividends are when the next ex-dividend date is, because you want to make sure that if you're going to sell puts for the dividend, that you're going to sell puts where you can get assigned before that dividend date. And that will put the odds a little bit in your favor for that setup. All right, I'm going to hit stop on the record.